Welcome to the Recruitment Leadership Podcast, hosted by Alison Humphries. The Recruitment Leadership Podcast is here to help those in the recruitment industry gain awareness and understanding on the hot topics faced by those in the business of hiring people. In each episode, Alison Humphries is joined by a fellow expert to offer professional knowledge, insight and advice on the biggest subjects affecting recruitment businesses. It's the podcast to listen to for recruitment business frontrunners seeking expert information from industry-leading advisors. Welcome to the Recruitment Leadership Podcast.
Good morning and welcome to this episode of the Recruitment Leadership Podcast with Alison Humphries. I'm your host, and today I'm delighted to be joined by Marie Pegram, who is Managing Partner of Recruitment Accountants. Welcome, Marie.
Thank you very much. Thanks for having me.
I think the clue's in the name. Marie's client base features a large number of recruitment businesses, all shapes and sizes, different sectors, lots of different issues. But today, she is going to share her experience and understanding of the recruitment industry with our listeners to help them make sure that they feel a level of financial confidence and that right from the outset, they have control of the things that really matter in their business. So we're going to broadly divide our discussion today into three sections. We're going to start, as most people start, with starting their own business. So making that leap from being a recruiter, no matter how good and how involved you think you are, to being a business owner and things you need to know from the outset. Then secondly, we're going to drill down on the crucial business of profitability, very different from the business of sales. And then we'll look at the main financial KPIs that you should be watching, in particular as your business grows, because most people who start recruitment businesses do not bring a huge amount of seed capital with them. They are typically starting them on the shoestring, and therefore having that control right from the outset is critical. And then our third section, which I hope nobody will ever have a need to use, but it's becoming more and more prevalent at the moment. Our third section is about when it all goes wrong. Issues with HMRC, raising loans, and the various other routes that you might look at in those unfortunate circumstances. Okay, so without further ado, I'm going to kick over to you, Marie. From the outset, what does everybody need to know?
That's a great question, and I'm delighted to be here. I think there's a lot of content to cover in this podcast as well. So at the outset, you're making a transition from probably being an employee to a business owner, which is quite a big step, and you'll find that you're going to have lots of different hats that you're going to have to wear as a business owner, and trying to get your ducks in a row before you start your business. So there's things like getting to grips with your compliance deadlines and your HMRC deadlines. So as soon as you incorporate your company, I recommend putting them in the calendar, understanding exactly when you're due to pay, what tax, by when, and making sure that you're tied up with an accountant advisor that will actually make the reminders for you so you know what you're doing. The other things I've seen work really well with new startups is having a separate bank account where if you're VAT registered, for example, when an invoice is paid, 20% of that invoice goes into a separate bank account for your VAT bill. So they're actually putting money aside for your HMRC obligations. So it's not a shock when suddenly you get your VAT bill come through that you don't know you've got the cash for it. And then looking at having a business plan to start with. So looking at what you need to do to start making your first placements. So whether you're a perm business or a temp business, you're going to have the first couple of months where you're probably not going to bill anything at all. So what costs have you got coming up? Have you got funds in the business that you can pay for those costs? And what do you need to do? What activity needs to show in the first couple of months to make sure that you will bill when you expect to bill? Because if you haven't made any placements at all in the first couple of months, then in a couple of, say 3 months later, if you're a perm business, you're not going to get any income in. So you've got to start planning for that. So I'd recommend having a very simple budget and a cash flow forecast as you start your business, so you can start mapping that out and keeping track of those.
A budget right from the outset is a great idea. Do you know what? Can we circle back? So before even, putting in notes about when tax is due. There is the whole issue of corporate structure, isn't there?
Yes. So you would incorporate business. Most people go as a limited company rather than be self-employed or partnership. And the reason you do a limited company is you want to protect yourself. So it's limiting the liability. And then you look at the shareholder of the business. So whether it's just yourself, whether you're bringing in partners, whether you look at bringing in spouses even for tax saving ways. There's lots of different corporate structures that you can do. So I'd recommend seeking advice before you start out, because as soon as you set up that corporate structure, it's quite difficult to undo. So getting it right at the beginning, I'd highly recommend. And also one of the things that I see quite a lot is when business, and I literally spoke to someone recently actually, who they're going in as 50-50. They found a partner, they think they're going to work really well together and it'll be brilliant. And then I started talking about a shareholders agreement. And it was like, no, we're on the same page. We're fine. We don't need to invest in a shareholders agreement. Literally a month later, they were already split because they had a disagreement. And it was like, okay, well, that's an example. And I've seen it happen years later as well, where they didn't have a shareholders agreement in place, which talks about how you resolve conflict, what happens if one of you's got different objectives to another, that you have an agreement in place to decide that, so it doesn't end up being this conflict and gets really, really messy. So that's something
it does. And I've what's the word, counselled 2 business partnerships through these sort of business divorces without shareholders agreements. It is very messy. You will not believe, if you go into partnership with someone, you will not believe how much your lives can diverge in the future. So it might be for lifestyle, somebody still wants to be playboy of the Western world and somebody else has settled down and is looking for different gains. In some cases, it's people's different responses to market challenges. So yeah, a shareholders agreement is absolutely essential if you are a limited company. Now, just to be clear, quite a lot of people start off purely as a lifestyle business. They only intend to sort of use their networks for, and their personal networks to do a bit of recruitment work and operate, from their home office. And for most of those people, I would argue that as long as you understand what you're doing, a sole trader status is absolutely fine at the outset. What do you think about that?
Yeah, the tricky thing is looking at tax implications. So all the money that you take out of the business is taxed as income in that year, whereas a limited company, you can actually decide on how you take the money out and maybe make some tax savings. There's also the thing about risk. So if it's a limited company, your limited liability, whereas when it's you personally, if you've got a contract with, say, LinkedIn or something like that, you are personally liable for that contract, and that becomes a different ball game. Whereas in a limited company, it's protected by the company because the company has the contract with LinkedIn, as an example. So it depends on, for me, if you're just going to dabble in recruitment and it's just going to be the odd placement here and there, and it's kind of just a lifestyle thing that's going to play around, your existing commitments and things, then maybe sole trader might be right for you, because there's not as much compliance and obligations that you need to do as a sole trader. But if you're going to make it be a bit more serious about it and it's going to be, say, a full-time career that you're doing, I would think about protecting the risk. Depending on how much money you're going to make out of it, and do a limited company.
Now, just to be clear, the what used to be the tax advantages between being a sole director of a limited company, as in the sole employee, versus being a sole trader, they are like wafer thin, and in fact, you might argue don't exist at all, given that there was no help for directors of limited companies available during COVID. There are also costs attached to operating a limited company. You will almost certainly have to pay an accountant to prepare accounts, VAT returns for you. But then, as a sole trader, you would have to do the same, but your accounts won't be publicly available. Now, what is available if you are a limited company is extremely limited if you're a small company, isn't it?
Yes.
So all that the public can see is, in effect, your balance sheet. They can't see how profitable you were in that year. HMRC has to see it for obvious reasons. So you made a good point, Marie, about dates and HMRC obligations. So when you start off, of course, your corporation tax is a long way away, isn't it? Because you've got 9 months to file your first set of accounts after year end, and then pay your corporation tax, but you are going to have VAT to return to the government. And once you become an employer, of course, you're going to have your PAYE and employers' NICs to submit regularly as well. I think you and I would agree, Marie, that one of the biggest mistakes that people make, no matter how successful they are as a biller, is that when they start, they confuse what's in the bank account of the business with that being their money. And when it comes back to bite, isn't it?
Yes, definitely. Yeah. When you talk to them, they're like, well, I've got 100K in the bank, so I'm doing really well. And it's like, that doesn't correspond with your profit as a business. And you may have 100K in your bank today, but then you may have a VAT bill going out tomorrow. So that could change very quickly. So I think keeping those separate into understanding what cash is in the business and profit in the business is you should be able to understand that from the outset if you can. I was just going to say, going back to your company's house point, actually, just to make a small point on that, one of the things that I do come across with new businesses is when they incorporate their business, they put their home address as a registered office address. That is publicly available. And that's something that I wouldn't recommend doing just when you incorporate, because I don't think you should really have your address publicly available for anyone to find. So yeah, just to come back on that. But yeah, going back to looking at the bank account, the profitability. So with your HMRC obligations, I would recommend having a list of all the taxes and all the dates that come up, because there's going to be some that you may catch you off guard. So one of them is your personal tax liability. And we find that when people are taking dividends out of the business, they think, well, I've paid my corporation tax, I've paid my PAYE, I've paid my VAT, and then suddenly they get a personal tax bill because they have to pay tax on those dividends as well. And sometimes you're even caught off guard by a July payment on account, which is when you have to pay in advance for the next tax bill. And I'm quite often talking to directors that are suddenly surprised about this. And it's like, well, you were informed about this. You need to put some money aside for these bills, making sure that you plan for them. HMRC can support you in payment plans,
and we'll come back to when it goes wrong towards the end of this podcast. Interesting thing, just 2 weeks ago, I was talking to a lady who was setting up on her own for the first time as a recruitment business. And we were talking about the costs she would have to incur right from the beginning before she had any invoicing to go out. It's interesting how misconceptions arise. I said, well, you may not need to pay for a CRM yet, but you'll find it difficult to do your business without some form of paid LinkedIn license. And she said, yes, but I can just write that off, can't I? And it then occurred to me that she had confused writing off a business expense so you don't have to pay corporation tax on that element of your profits. And she actually thought that debt was disappeared magically.
Oh, right.
Yeah, because people throw those terms around, don't they?
Yeah. So I think, making a list of all the costs that you think you're going to anticipate when you first on the outset. I'd also think there is going to be things that are going to pop up that you're not going to have thought about. So have a kind of contingency, overestimate slightly the costs that you think you're going to spend, because there will be something that's going to pop up that you thought, oh, I didn't think I needed that. How am I going to pay for it? I think LinkedIn is the toughest one because it's so expensive. I think I hear recruiters talk about it all the time. And one of the things I think which has come up a few times in terms of the length of contracts that you're tied into as well. And sometimes you can get attracted to the longer contracts because they're cheaper monthly prices, but actually have a look at what you really need, because you might not need those, might be worthwhile paying the higher price, but for a shorter contract, just to remove the risk of being tied into something that you don't want.
Good point. Yeah, good point. Okay, so let's move on to the second section. We're going to talk about the thorny issue of profitability, which is very close to people's hearts at the moment. Just to set the scene, I think it's essential for new recruitment business owners to understand, actually even some that have been doing it for a little while, to clearly understand there are 3 languages you've got to speak. Yeah, one is sales. And if you're a recruitment business owner, people expect you to drive sales, the direction, the focus, the market, your sales proposition, your pricing, and so on. Okay. And sales is very immediate, isn't it? It's about promises, in effect. And then there is the second language, which is about invoicing. What translates from promises to actual issues that you can invoice on? And indeed, when you do, what are the terms on those invoices? How likely are you to have to pay rebates? And, how are your invoices holding up on average in terms of both percentage and pounds? Yeah. And an invoice, if your business closed tomorrow, a legitimate invoice would be a form of asset, would have a value. But what really counts is, of course, cash. And so when the cash is going to arrive can make or break your business. And I'm sure, Marie, you've seen businesses struggle because they may have secured what looked like a phenomenal sale, but no cash.
Yeah, well, I think it's the whole process that goes around it as well, where I've seen it fail. It's like I've secured this placement, I've raised the invoice, right, done. It's like, well, that's not done because you haven't actually been paid for what the work you've done. Then you find out that the invoice is in the wrong format. It's been sent to the wrong person. It hasn't got all the right details. So then they don't pay the invoice. And then it's another, admin task that needs to be done before you get paid. And before you know it, it's stretched out and your payment terms could be, I don't know, great payment terms be 14 days if it's a perm invoice, but it could stretch to 30 to 60 and then you haven't had that cash for a while and you're trying to keep the working capital of the business going.
Yes.
So I think absolutely nailing that invoice process is essential in turning those placements into cash.
Really good point. And it starts right at the outset of the placement process, doesn't it? Is getting the correct details. But as far as a client's concerned, this process isn't over until the rebate period is over.
Yeah.
And too many recruiters get away with, yep, deal's in the bag, ring a bell somewhere, everybody cheers for them, and then they never speak to the person again. And those things really do come back to bite you. Rebates that you weren't anticipating, and it's quite sector specific, but it can make a huge dent in your profitability. So the absolute importance of managing cash and checking that the between those three languages, if you like, sales, invoicing, cash, checking that there is not a significant gap between them in amounts. That's really important. Yeah. If you have got a significant gap between those three numbers, then look to how you're managing your business. Yes, now, you mentioned earlier the importance right from the outset of creating some kind of budget. And, a budget can't run your business for you, can it? All it can really show you is, like, if everything went according to this plan, this is what would happen. And of course, people can and do make spending decisions that they didn't budget for, quite often off the cuff. And without a clear idea of where the return on that investment is coming. And one of the biggest things they make, mistakes that they make sometimes, is budgeting for a new hire. And people, as we know, are very expensive now, budgeting for a new hire without realizing when that new hire is actually going to start contributing to their business.
Yeah.
We know, don't we, that if you're a temp or contract business, it can take a year before that person starts adding to the bottom line.
Yeah, definitely. Yeah. So I think planning for that hire in terms of having at least 6 months before you see any kind of income, whether it's perm or temp, from that individual. So making sure that you can cover their costs for the first 6 months is what I recommend, especially with your first hire. And then I think it goes. One thing that often gets missed sometimes is the accountability touch points as well with the first hire, because it's all very well keeping an eye on the numbers and saying, well, they're not billing. But actually, what KPIs are you keep holding that new person to account? What training is going in? How are you showing them the ropes? How are you giving them the best possible start to get them to bill as quick as possible? Because what you don't want is...
This is so true, Marie. I could not agree more. So when I sit in leadership meetings or board meetings, whatever, and people say to me, I'm going to extend such and such's probation. And I'm like, hang on, we've got to 6 months. And we're not talking about exceptional circumstances here. We've got to 6 months and you don't know if that person's going to work out. Well, how have you measured their performance so far? well, we thought they'd made a placement, but then they hadn't, and that's it, you know.
Yeah.
So the kind of things that as a sales leader I would be looking at throughout probation is, first of all, how much they'd taken on and used of the training provided. That's really key. I would want to know what they had generated in terms of engaged applicants, what they generated in terms of interviews, if interviews apply in your sector, not in every, their business development calls, if you've got them doing it, and what they generated in the way of jobs and or meetings. So those are, even if it's by Zoom, those are still a sign of commitment. And of course, referrals. So those are all measures of not just the quantity of what people are doing, but the quality of what they're doing.
I think as well is that when you mentioned obviously KPIs, so many people focus on output KPIs and, you know, kind of, right, this is the metric that they haven't hit, this isn't hit, blah, blah, but it's not looking at input. So what activity, exactly what you're saying, what activity needs to be happening right now, your input KPIs that will achieve your output KPIs. And I think that's really important, especially in their probation period as well.
Yes.
Because some people are lost and they don't know whether they're doing well or they're not doing well. If they don't have those meetings and engagement, then
and you know, I have known very, very good, particularly perm recruiters, who take a long time to get a deal over the line. But in the meantime, they've built a really good understanding of the industry. People will take their second call, you know, and they've worked jobs and you've got a lot on board. But then the tricky bit with this is that inputs don't always lead to outputs. But let's be honest, there is some luck in recruitment as well. So one placement does not a recruiter make. And I think we're getting better at an industry at looking very carefully at that. So we've just talked about, one financial KPI, which would be the contribution that a new hire makes and when they make it. Let's drill down on that now, Marie, if we can, and look at what the key things are. If you were telling people, like, be your own doctor before you have a meeting with me, your accountant, you know, these are the things you should look at. What would they be?
Yeah, I think for me, the most important KPI for a recruitment company who has staff is staff cost to net fee income ratio, and making sure you can measure that sensibly as well, because you've got to make sure you're matching commission in the right quarters with the billing and things like that. So matching, you know, cost to income. So cost to net fee income is the most important percentage in my books. Then if you're looking at the business overall, I would say, which I know we've discussed about this before, Alison, is we work to a 60-20-20 ratio. So 60% of your net fee income goes to total staff costs. So that's directors, dividends, like market rate salary for your managing director and things like that. Commission, bonus, training costs, things like that, all staff costs, 60% goes, your net fee income goes there. 20% of your net fee income goes to overheads and 20% is your profit. And if you can get to those ratios, that is a nice shaped business. It's not fantastic, but it's not awful either. It's a nice ratio to focus on. And I'm finding when we've done our benchmarking reports where we've seen people at the moment, because it's tough, you know, salary costs have gone up, national insurance has gone up, overheads have gone up. And I'm finding that quite a lot of businesses, and not so much now, but at the beginning of the year, we're hoping for, it's all right, it'll improve. I'll carry these extra costs because I know it's going to improve, and not being proactive in addressing that. And so these metrics, so it's, instead of going 60-20-20, we looked at our Q2 and it was 69%. So 69% of the net fee income was going to staff costs, 24% was going to overheads, and 7% profit. And that's not great at all. So it's looking at trying to adjust that. So that's overall. And then drilling down into more other metrics. So I'd look at your debtor days. So that's time to pay for invoices, which is what we've spoken about before, and seeing whether they align to your payment terms. So if you've got debtor days of 60 days and your payment terms are 30 days, then there's clearly a problem in terms of collecting that debt.
Oh, and just to throw in there, also, if you look at your age debt, is it overly weighted with one client, which can be very alarming if you're waiting for a lot of money from a business that isn't paying up.
Yes, yeah, definitely. And also you'll find sometimes with the old debt that you'd find there's just one little query that needs to be cleared up and then it's gone. So just making sure that gets addressed. And then looking at consultant profitability. So I'd recommend a business to have an idea of what each consultant is contributing to your overheads. So looking at their direct billings and then what their direct costs are. And what does that look like in whole numbers, not metrics type things. But that then sees, because what you find is you're going to have consultants on different base salaries, maybe different commission schemes. You could have a top biller that you think is amazing, but actually not that profitable for your business because you're paying them a lot more commission and the base salary is higher. So I'd track that consultant by consultant, and you'll be amazed at actually the ones that you think, oh, their billing's all right, but actually they're highly profitable for your business. Because you've got those metrics right. And it also, looking at that as well, it will test whether you've got your commission scheme at the right level, because you'll see sometimes your commission, you can end up overpaying top billers or or overpaying your poor performers as well. So it's looking at those metrics will help see that you've got your
And do you know what? I think we've already agreed we're going to have to do a whole other podcast on commission because it's a complex issue. But yes, it has become a bit of a problem, partly because of rising demand, particularly from those who are experienced recruiters. And the other thing that has happened over the last, I'm going to say decade-ish, is that base salaries have completely become untethered from commissions, whereas they used to actually form part of an overall package. I think you and I are slightly, people who regularly listen will have heard me quote the figure of, I think a payout percentage of 40% is where we should be aiming. And that's because, listeners, Marie and I have a slightly different method of calculating it. So I would not count everything that a director draws from a business. And I also wouldn't include in my calculation things like training costs, etc. I'm only talking about wages and commissions. But the overpayment of staff, or if you look at it from the other end of the binoculars, the underperformance relative to their costs of certain staff is a big problem. And I guess I'm going to have to draw a line under commission because otherwise it'll hijack the whole of this podcast. But the one thing I would say is very few recruiters I know have made the mistake of making their commission contractual in writing. However, in employment law, if you do not review a policy, if it just stays in place year in, year out, because you're scared about the reaction of changing it, then you have made it contractual. Yeah, de facto, you've made it contractual because it was never queried, it never changed. Therefore, it wasn't just a policy, it was a right, if you like. Well, I think we've probably all seen just how much a market can turn if we just think about a timeline since 2020 and shifting your response to that, or at least reviewing it once a year is kind of essential, isn't it?
I think commission schemes don't get reviewed often enough, especially with when you're offering different services. So I noticed that quite a lot of recruitment businesses are changing their service mix and what they're delivering to clients now, yet they've still got the same commission scheme. So looking at trying to align those as well.
So you're talking about, for example, the way we reward 360 recruiters compared to those who are job fillers, resources. Yeah. Okay.
Yeah.
It's a really good point. Split fees. That's the answer. Anyway, so we've talked about, yes, looking at profit, looking at contribution per desk, return on investment of any non-budgeted spend, including staff. We've talked about payout percentages. Anything else you'd add to your list of financial KPIs?
Yes. So I'd add average fee. So looking at, and also average client spend, because I find sometimes you get so focused on building new business and going out and winning new business that actually looking at your average client spend in your business, you could actually increase that and just work on building better relationships with your clients.
Yes.
So I'd have a look at that and also compare it from this year to last year. So how much did, client ABC Limited spend with the business this year compared to last year? Has it gone down? Has it gone up? What are the reasons behind that?
Do Do you know what? It's interesting you mentioned average fee, because that's one of these boiling frog type KPIs to me. I think most people are familiar with Charles Handy and the frog who doesn't feel the change because it's gradual, and so is boiled to death. When you look at things like average fee over a long period, and I'm talking in more than a year, and indeed look at total job flow or time to fill, these are not financial necessarily, time to fill over a year, and track that and how it's been moving, that's when you start to see the real underlying trends that are much harder to shake. Yeah. So I've worked with several businesses whose average fee has, they've stuck at a percentage in their heads. Then they've given away more in terms of payment terms and so forth. And at the same time, the salaries have not increased. Now, a lot of recruitment businesses have relied on salaries increasing and therefore placement fees increasing. Yeah. But that hasn't happened to such a great extent, has it? The time to fill one is one that listeners will have heard me speak about before. And that has definitely extended in pretty much every sector I know.
Yeah, I think people are just taking longer to make decisions, aren't they? So it's just, I completely agree. I think to dovetail that as well, I'd look at just your fill rate anyway. So how many vacancies have you got and how many you're actually filling? And actually, because sometimes you end up either having too many or you've got the wrong type of vacancies that are coming through that people are wasting time on. So yeah, looking at that as well, because that will impact your time to fill as well.
I really liked your point about average client spend. So account penetration is a really important thing to look at. Okay, so there are financial KPIs looked at in the context of operational KPIs, business development KPIs, and people KPIs, don't they? So these all form part of a balanced scorecard. But at the end of the day, people, operations, processes, none of them are going to happen unless we make a profit.
Yep. Just to touch on that, I guess we're talking about pricing and stuff as well. One thing that I've seen some recruitment businesses get wrong is the temporary worker margins. So looking at all the additional costs that come through when employing a temporary worker with your employer's national insurance, holiday pay, pension, and making sure you've actually got your consultants understand how they're pricing, negotiated rates with clients. Because often those can be missed, and then before you know it, you're actually making very, very small gross margin.
Yes, so true. Especially if they're using the same pricing mechanism when a temporary worker or contractor is only going to do a few hours or separate assignments. Yeah. Okay, so look, in the time that remains, let's have a look at what happens when it all goes wrong. The recruitment industry has always been one where businesses have folded and new businesses have started, but there are increasingly, I think we have to be real and say that recruitment business owners are looking at their accounts and thinking, am I going to make a loss this year? Can you just talk listeners through the process of when you make a loss, what could happen, how to deal with it?
So if you're going to make a loss in your business, there is opportunities in terms of corporation tax. So you don't have to pay corporation tax if you make a loss in the business, and you can look to carry those losses back 1 year, so you can offset the corporation tax that you paid last year, which could help you, or you can carry those losses forward and offset against future corporation tax. Or if you're part of a group, you could get grief relief as well. So there's things that you can do with those losses. So it's not like that's it, you've lost it and you don't get any kind of payback for that. And then where we mentioned before in terms of if you're unable to pay your HMRC bills and things like that. So if going beyond, you haven't made a loss, but you've made a profit, you've got a corporation tax bill to pay, or VAT is sneaking up on you or things like that. There are arrangements that you can get with HMRC, but I'd recommend tackling them head on. So picking up the phone before the liability is due, talking to HMRC, and they will work through a payment plan with you. As soon as the date's gone and the debt is due, HMRC aren't as kind in terms of helping you set that up and do a nice time to pay arrangement that fits with your business.
Sound advice. Now, I've noticed increasingly offers coming through of corporation tax and VAT loans. Any thoughts on those?
Loans as in from external finance companies? Yes. the interest rates are extortionate and they tend to tie you into an agreement that is probably not works well for your business. So I wouldn't, those sort of loan companies I would steer well clear of, and actually get proper advice. If you need an external loan to cover those liabilities, then go to, there's brokers out there, or there's, go to your bank and actually get an overdraft maybe in place or something like that put in place. Whereas if you go to these loan companies that just give you a quick loan, high interest rate, you can get yourself in a real sticky situation because you're trying to repay that as well as high interest, and it just becomes this continuous loop of payment.
Yeah. I mean, those are distressed purchases, and their marketing is designed to give people quick solutions so that they don't interrogate them so closely, isn't it?
Yes, exactly. Yeah, it's awful, really.
Yeah. So your advice would be to preemptively speak to HMRC about these situations.
Definitely.
Yeah.
And speak to your accountant as well. It's that they can. I've sat on calls with HMRC and our clients to help negotiate a deal. So you're not alone on that.
Yeah. One of the issues that I know people who've run into this is that in adjusting from being a, frankly, quite well rewarded recruiter to a business owner, they've underestimated the costs that will be involved, and at the same time they haven't really thought about their own, what money they're drawing. So what they've done is drawn money out of the business as advanced dividends, if you like. So they've assumed, okay, the first half of the year, we're not going to make much money, but it'll all come good in the second half of the year. So I will continue to draw money out of the business like it was a salary. And they get to the end of the year and there isn't, and remembering, of course, that dividends can only be taken post corporation tax. And then they realize that actually there is, after corporation tax, there isn't as much profit as they've already drawn. So just talk people through what happens then.
Yeah, you're spot on in terms of making it very clear. So you have to have distributable profits to take a dividend. And that can be previous profits that have been built up in previous years. So you've got retained profit and you can draw on that as well. Where I've seen it fall down is people using the company as their own personal bank account. So just drawing out as and when with no real structure, and then they don't realize how much it accumulates, and suddenly it's a surprise when they get their accounts or they look at their finances and think, oh my goodness, I've drawn that much, what am I going to do now? So I would recommend having a look at what you need to live on sensibly as a business and taking it out in a structured way from the business, and making sure that you have a look at your management accounts on at least a monthly basis to make sure that you have sufficient funds to take that out every single month, and you're making enough profit to cover what you need to take from the business. And then if you make an extra, you can take an extra dividend, you can take a bonus dividend or things like that if things are going really well. But I would structure it in that way, so it's not as and whenever you need some cash, just go and use the company credit card and it'll just be a loan. If you're overdrawn at the company's year end, you have 9 months and 1 day to repay that loan back to the business. If you don't repay it back to the business, there's a tax charge called Section 455 that the company has to pay, and it's 33.75% of the loan that's come out of the business, which is the higher dividend tax rate. So you have to pay that tax, and then HMRC will refund you that tax once you repay that loan. So it's not free money from the business. You do have to pay that. My recommendation is just to have some structure and don't just use your company as your personal bank account.
Yeah, so true. And just to be clear, given that the vast majority of small micro business owners pay themselves a minimal salary that goes through payroll and then pay them rest of their, whatever they get as dividends, these are separate entities and dividends can only be taken after corporation tax. Whereas if you actually pay yourself a salary through the payroll, then as a director, you would also be paying PAYE and NICs on that salary. Now, legitimately, if you're doing that, you can, in effect, trade at a loss because you've already paid the tax, assuming you have, of course. You've already paid the PAYE and NICs that are due on it. You cannot do this with dividends. You will be taxed. And you can't run away from a director's loan either, can you? Okay,
So what I'd recommend, just to add to that as well, is I think most small business owners use an accounting product like Xero, and Xero you can set up reports on there where dividends can show on your profit and loss. So you can actually see, right, this is the profit I've made, this is the corporation tax provision, and this is my dividends, this is what I've got left over. So I'd recommend getting it set up in that way, so you can see that on a regular basis and know if you're drawing too much from the business.
We could only cover broad headings here today, but I hope you've seen a journey from starting your business through to managing and controlling your business for profitability, and then what can go wrong towards the end. There is far, far more that I'm sure Marie can advise and her colleagues can advise on. And likewise, my advice through Recruitment Leadership covers the whole gamut of operational, sales, people and money. So please do feel free to contact either of us for follow-up on this. Marie, they should contact you, I think, via LinkedIn. That's Marie Pegram, Pegram, at Recruitment Accountants. It also shows up as TC Group on your LinkedIn profile, doesn't it?
Yes, we are part of TC Group. So Recruitment Accountants is a division of TC Group. Just to be completely clear.
And you can contact me, Alison, at Recruitment Leadership. So back to you, listeners. Thank you so much for joining us today. Hope you've enjoyed it, and I hope you've learned something to take away and use. And please do join us again for another episode of the Recruitment Leadership Podcast.
You've been listening to the Recruitment Leadership Podcast. If you enjoyed our podcast, please subscribe, review, and share so that others can find the podcast too. We really appreciate your support. If you have any questions about the topics covered or wish to find out more about recruitment leadership, please email alison@recruitmentleadership.co.uk, referencing the podcast. We're also on LinkedIn, where you can follow Recruitment Leadership and connect with Alison Humphries. Thank you for listening, and we hope you join us next time for another episode of the Recruitment Leadership Podcast.